What's up guys, welcome to the Elf Crypto. Greetings to all friends. Today in this session, we're sharing useful content. It's about 153 pages. I will try to briefly summarize all the content included in this PDF. I think this will make things a lot easier for you. The book we are going to discuss is Market Structure and Powerful Setups. The entire book is about market structure, and its content is laid out like this. First, it introduces the basic concepts of market structure. It examines important liquidity areas, order blocks, daily range price action, and the powerful setups taught through the ICT method. Some of the best setups are presented here, and in the end, when you put all these concepts together, you'll get a comprehensive, precise, and even excellent conclusion. By integrating what you've learned, you can make great trades. At the end of the book, there are also a few examples and charts, so you can see how the setups worked in practice. Alright, let's get started. The first chapter covers the basics, the fundamental principles of the entire ICT system. The first concept we'll address is expansion and retracement. What does this mean? It occurs when there is a sudden movement in one direction, whether upward or downward, followed by a retracement or correction. The correction is defined as a reversal after a sudden move. So imagine an expansion happening with momentum, for example, an upward move, and then smaller bearish candles appear as a correction. This is often the retracement. There are examples. An uptrend is on the left, and the downtrend is on the right. The letter E stands for expansion or movement, and R represents retracement or correction. Here, an example from the chart shows an expansion, followed by a retracement. After the downward move, we expected a retracement, but instead, a stronger expansion than the previous one occurred, which we refer to as a break in market structure. When the higher highs and lows start forming after the break, as you can see, there were lower lows, but now there are higher highs. Therefore, I expect that next time the price retraces into specific areas identified through different methods, we will enter a trade, and the upward movement will resume from there. Our next topic is Fibonacci retracements, which are used to determine when a corrective move will end. Typically, price reacts to the 50% level, meaning that after the price retraces 50% from the market high or low, it is expected to resume its previous direction. Levels like 62%, 70%, and 79% are also discussed in the ICT method. The 70% level shows the optimal entry point. Although there are many Fibonacci levels, I believe these are sufficient. Usually, the 50% to 79% range offers great entry points in the market. As we discussed, if the price retraces by 50%, it can resume its previous movement. Sometimes, however, if the price continues its retracement beyond 50%, we expect a reaction at the 62% level or higher, where the correction will likely end, and the price will resume its trend. Here you can see an expansion move. A BMS has occurred, which I will explain shortly. The expansion has completed its correction. One method to measure how much correction is expected is the Fibonacci tool with specific levels like 50%, 62%, 70%, and 79%. You mark this range, then go back to the chart to find a reason for entry. For example, in this move, we consider it the start because this candle broke the level, and the move you see is a retracement after a break. So, when the price retraces, aiming to grab the stop losses above, it reaches the order block range and resumes the downward move. From 50% to 79%, we search for a reason to enter, and it's that easy to find an entry point and enter a trade. Next, let's discuss BMS, which stands for break in market structure. This occurs when the price breaks above or below a swing or closes beyond it. Recently, even a shadow penetration is considered acceptable by some experts. Essentially, every trader should align with a higher time frame's BMS. What does this mean? It advises you to use multiple time frames. For example, in the 1-hour time frame, before confidently entering, it's better to go to a higher time frame and make sure the larger structure has formed a BMS, giving you confirmation in the opposite direction. This allows you to search for entry points with more confidence. It's also important to note that after every BMS, a retracement is expected. Two interesting points. First, you always wait for a retracement after a BMS. If an expansion causes a BMS by breaking the previous swing, we don't enter the market immediately. We wait for a range to form and for the retracement to occur before searching for entry points. Let me explain this example. It's similar to the previous one in a downtrend. Here, a BMS was formed. Secondly, after this swing is broken, we can say it's a BMS. As explained, a BMS is a break in market structure. If the structure doesn't break, I can't say whether it's a BMS or not. Pay close attention to this point. Now, about swing conditions. I'm not sure if you know about the fractal rule, but I'll briefly explain it. To form a swing high, imagine we have two positive candles, followed by a third positive one, and then two negative candles afterward. This would create the swing. For a low, two candles need to be higher than the previous low, and for a high, two candles need to be lower than the previous high. Lastly, I explained OTE, which stands for optimal trade entry. We always look for a reason to enter. When you use a Fibonacci retracement, you expect a reaction from the 50% to 79% range. In this section, the price retraced even to the 79% Fibonacci level before falling again. The next example follows a similar pattern where the formed swings were broken one by one. After a downward trend from point A to B, an expansion occurred that led to a BMS, and here the market structure clearly changed. The BMS formations continued to align with the trend. What happened next was a swing that failed to break higher highs and once again reversed, failing to rise further. The market broke the previous low, transitioning from a bullish trend to a bearish one. We saw the same movement again, a low formed followed by a drop. We expected a correction here before continuing downward, but instead the price went up, forming a BMS, corrected, and this time we began searching for entry points in the previous chart areas. You can use Fibonacci or other methods, and as long as the higher highs are broken, we look for entries. Regarding range highs and range lows, a new price consolidation forms after every BMS, known as the range high and range low. This price stabilization always happens after a BMS. It is emphasized that this always occurs. Another point is that we should trade in the direction of the BMS, which is clear. After a BMS, we should wait for a retracement or correction to the 50% Fibonacci level or other Fibonacci levels. The OTE is another possible entry point after the BMS when the market corrects. Here it's also shown schematically with bullish and bearish examples. After an upward movement, imagine we had a swing, and then the price makes a move up. During the correction, a range low forms, which is essentially a consolidation where orders accumulate. After this consolidation, the expansion continues. Post-structure break with this expansion, another range is formed. During the correction, we wait for entries using patterns and methods like Fibonacci. This type of entry, compared to another method, has slightly lower risk, but still provides good take-profit targets. Essentially, after a drop, we see range formations during the correction, then new setups are created. Upon the return to the broken area or order blocks, we can enter a sell trade with lower risk. Looking at the chart examples, you can see the pattern: break, pullback, retrace, and expansion. A BMS is followed by another BMS, where a range low forms but hasn't broken yet. There's a stop hunt, and a bearish outlook is still present. The chart shows that the market hasn't yet given a sign of reversal. The next topic I want to explain is the failure of a swing high. This doesn't mean that a level is necessarily broken. Pay attention, this is a swing high, and the next swing couldn't break above it. It failed, meaning it was unable to break through. This failure that is seen here refers to that inability. Now, let me explain the concept further. When the market is in an uptrend, the price cannot break the last resistance level ahead. For example, when the market is in an uptrend and the price cannot break the last resistance level or the previous swing high, what happens instead? It reverses and breaks the previous swing low or the previous support level. At that point, we say that an SMS has formed. For a downtrend, the exact opposite applies. This example shows an uptrend where the structure is breaking. The market hits a peak, then fails to make a new higher high, and a change in structure occurs. However, at this point, a break hasn't happened yet. So we should note that this is just the first warning, not confirmation. Confirmation occurs when the last support level is broken or engulfed, turning the trend bearish instead of bullish. Now, moving on to Chapter 2, where the structure of the market itself is addressed. We must always remember that when we open a chart, usually three things are happening at the same time. The price can be in one of the following three phases: consolidation or ranging phase, an uptrend, or a downtrend. It's never outside of these three. Often, all three phases can happen in the market, and it's not necessarily one or the other. For example, when you open your chart in MetaTrader or TradingView, you'll often see that the price was in an uptrend, then moved into a range, and eventually continued upward before finally reversing and dropping. A more detailed explanation is given here, saying that the structure of the market in a bullish phase behaves in a certain way. The characteristic of a bullish market or an uptrend is the formation of higher highs and higher lows. If the price forms higher highs and higher lows, it is the main feature of a bullish market. However, just forming higher highs and lows isn't enough. It's mentioned here that in bullish markets, price doesn't always break through higher highs or respect swing lows. These details are essential to understanding price movements. If the price breaks through swing highs, we can expect higher prices ahead. In such conditions, we say that the market structure is broken. Once again, this chart explains how the market structure in an uptrend looks. You can see that BMS forms one after another with its breaks. Look here, we had a high, and that high was broken. We had a low, and it wasn't broken. The price either stays above it or remains parallel. In any case, the structure breaks don't happen down here. To change the trend, the price must break downward. Then we can say, okay, now there's a chance the trend will become bearish. Now, even though this point is simple, it's very fundamental. The highs keep breaking in an uptrend. As I mentioned, in an uptrend, the price only breaks the highs with these expansions after a BMS. The price returns to the 50% level or other Fibonacci levels for a retracement. Here, the term retracement may not be mentioned explicitly, but it definitely happens. Rest or correction will always occur after the move. Now, in this example of market structure, we see the same scenario. Pay attention, this is the fourth time this has been mentioned. In an uptrend, the structure breaks in sequence, and the lows are even respected at higher levels. The last low where we expected support was broken. After the break, the peak that formed here was sort of an SMS because it couldn't form a higher high. Here it formed a lower low, and from there it couldn't make a higher high. This is the core of the matter. You should enter the market here with stop losses placed below. Now let me continue with the next important topic. One very important point, and something I urge you to pay close attention to, is the topic of liquidity. Allow me to briefly review. Okay, the Forex market is a zero-sum game. What does that mean? It means that for every move in one direction, there must eventually be a move in the opposite direction. For example, if buyers enter the market, sooner or later, sellers must come in to balance the trades. Otherwise, let's say for instance, EUR/USD has stayed in a similar range for years, only fluctuating slightly up and down. So the Forex market is a zero-sum game, meaning if a trader or a trading institution buys or sells, there must be a counterparty to the trade. For instance, if a bank buys, another institution or trader must be selling that same currency pair for the trade to be completed. What drives these buying and selling opportunities in the market is called liquidity. Liquidity can be defined by stop losses. Wherever there are stop losses, there is liquidity. Therefore, smart money needs to trigger these stop losses to execute their own orders in the market. Very simply, you place a stop loss and the market comes and hits your stop. What happens at that point? You get kicked out of the market, and the money you had on your screen goes into the bank's pocket. This happens through the opposite trade. If you were a buyer and had a stop loss set, the market will hit it. In fact, you sell at a loss, and someone else buys at that lower price and enters the market. It's a fascinating concept. Let me review it quickly. Banks manipulate prices because of liquidity. But why do they do this? The orders from banks are massive, much larger than you might think. For instance, a bank might want to place an order for 100,000 lots, and sometimes when they want to make heavy purchases, they can't find enough sellers on the opposite side. Like we mentioned before, liquidity is what the market needs. When someone wants to buy something, there has to be a seller on the other side. If everyone thinks a particular level is support and that they should buy, then who will sell? Therefore, what do? They manipulate the price to create sellers, and for their selling orders, they need buyers. It's that simple. As long as you think there is support at a certain level, you would never sell there. You would be looking for a buying opportunity. The banks know this. They are much smarter than us, using intelligent algorithms designed by the sharpest minds in the world. They are always ahead, always one step in front of you. So instead of fighting the market, we try to understand their behavior and act like them. Cheating is usually considered bad, but I say it's actually a good thing here if you can learn something from it. Learning even a single new thing in life is valuable. So cheat and trade like the banks do, guys. Types of liquidity. There are two main types of liquidity in the market. In Forex, one is buy-side stop liquidity, and the other is sell-side stop liquidity. Buy-stop liquidity occurs when the stop losses of sell orders are activated. The liquidity from this situation is created in the market, causing a reversal, and the market enters a bearish phase. Pay attention to why this happens. Banks use buy-side stop liquidity to place their orders. Remember, when we talk about the market, it's not about you or me anymore. It's the banks that are in control, and they're only after liquidity. They don't care about your patterns, channels, trend lines, or Ichimoku indicators. They are purely focused on finding liquidity to fill their orders. Now, we come to this section regarding BSL buy-stop liquidity. What do you want to call it? The highest peak on that day, whether it's during the Asian session, London session, or New York session, it doesn't matter. The high has been formed, but the swing highs are in a BSL state. We have stop losses placed above this peak. The last peak formed, wherever it is, will be the closest peak. It doesn't matter if it's a double top or double bottom pattern we learned before. What's important is that there are at least two peaks next to each other, parallel with a slight difference of around 10 pips higher or lower. Even with this small difference, it is considered equal. In this example, you can see these are the old highs. These old highs could be from last month, last week, yesterday, or even from the same day, which is HOD. It could be from last month if we are looking at a higher time frame. For instance, in a monthly time frame, a daily high would appear much larger in comparison, even though you are analyzing it on the daily chart. The peak here would correspond to a weekly or monthly high. What happened is that the market was seeking liquidity. You might have wanted this level to break and go higher during a correction, assuming you were a buyer. The market knows this. So what happens is that those who wanted to sell before reaching the peak placed sell orders. They set their sell orders around these levels, and as the price moved up, it hit these stop losses. This led to a rush into the trade with stop losses set higher. Additionally, they placed buy stops, meaning if the peak was breached, they would buy. This way, both stop losses of sellers and buyers are taken out, and the market's goal is to capture liquidity. In this context, even with a double top pattern, liquidity is being captured. Let's quickly review the chart examples, from monthly to daily and even 4-hour charts. A bullish candle formed a peak, then stopped at that level. The market then reversed, reflecting a monthly trend. Always try to create a schematic pattern on your chart when analyzing. If you expect a stop hunt at a certain level, draw that pattern next to your chart to recognize the formation. These patterns are order patterns, not harmonic patterns like crab patterns or others. What I see in the market now is order consumption and collection. You should also align your perspective with this approach. When does SSL happen? This occurs when stop losses on buy orders are activated. The liquidity from this situation helps banks place their buy orders. When sell stop liquidity is consumed, the market turns bullish. For example, here stops were taken out, leading to a rise. As you can see, the market always seeks liquidity. I skipped these parts because they are exactly opposite of BSL we reviewed. When BSL is taken, the market reverses to the downside, and when SSL is taken, the market reverses to the upside. Stop hunt manipulation to attract liquidity involves neutralizing liquidity from stop losses. Banks often use impactful news to attract liquidity through stop hunts. For example, if they want to place large buy orders, They might encourage others to sell by creating false breakouts or fake news. In summary, banks use stop hunts to capture liquidity and manipulate the market. Always monitor news calendars to see which currency pairs are likely to move based on the news throughout the day or week. If the video is too long, feel free to review the content, and I will continue to the next part in the next session. Thanks for watching.